John, you're like you guys are a growth tech oriented,
Yeah.
investment bank, research shop. How closely are you watching Jackson Hole?
Yeah, I would say, fairly closely, just as potential read-throughs to obviously any of the expected cuts, right? I think there's what, like an 83% probability. So anything out of that, what I would say though is my universe, it doesn't bounce around. They're not too sensitive to interest rates. Some of the names are, right? Like if you're a stable coin issuer and a lot of your interest income comes from that, you're going to be sensitive to what happens with interest rates. But I would say even within that, like the growth story for stable coins, the growth story for Coinbase, for Robinhood, for eToro, all those names is significantly bigger than just kind of where interest income goes next quarter because of a certain cut, right? And then when you get to your Bitcoin miners, funny enough, I would say most of your Bitcoin miners don't trade with Bitcoin anymore. Most of them trade around this high performance compute, HPC narrative, and where those AI workloads are going. So, like, they're going to trade more around if Sam Altman says something on AI, and if AI is in a bubble and stuff like that, versus anything you kind of see out of the Fed necessarily.
And why is that actually, John? Because I can sort of see how that transition can be taking place, but it'd be really great to hear from an expert why that's happening in your own words.
Yeah, sure. It's because most of their power capacity, they're now transitioning towards supporting AI workloads, both
Yeah,
inference
it's amazing.
and training AI workloads. Yeah. So, and the revenue that could come in, and also the margin too. Like when you look at EBITDA margins, that margin differential between HPC AI and Bitcoin mining is quite a bit different. HPC, you could get 85% margin. So not only are you generating maybe more revenue per megawatt, your margin's also significantly better. So most of the miners are either going down that route or seriously considering it. At the same time, the market, like crypto is super hot right now, but AI arguably is hotter. And so what equity investors are willing to pay more premium on valuation, you get a better multiple by being an HPC company than a Bitcoin miner. So I think it's kind of a few things going into that, but your miners very much are seriously going down that route, and most of kind of their future expectations is whether you land a lease in HPC. Everyone has a pretty good handle of how much Bitcoin you're going to produce in 6 months, in 9 months. Obviously, the market changes a little bit. The price of Bitcoin is going to change. Network hash is going to change. But for the most part, these companies give pretty good guidance on how much hash they're going to have online. But what's the bigger question is if you go sign an HPC lease tomorrow, you could 2x your revenue, 3x your EBITDA. And that is just kind of a night and day difference. And it's also just a fundamentally very different business that brings in a lot of different equity investors. So you are seeing them trade more around that potential than kind of macro or even Bitcoin.
Do you see these miners as just kind of like, a segment of HPC? Like one day, like, will they just not be known as miners to layman folks? They're just going to be like, this is an infrastructure play on AI because it's becoming so consuming.
Yeah, 100%. I think they're going to become data center operators, and you're going to think of them as data centers, the same way you look at Digital Realty or Equinix. So I think that the days of being, hey, I'm a Bitcoin miner, starts to look different. Now, some of these names are still going to have a lot of Bitcoin on the balance sheet, so it's hard to be, hey, I'm a data center operator, but I have 2 billion in Bitcoin on my balance sheet. So I think some of those names they're going to have that Bitcoin moniker around for a bit, but a lot of them don't have Bitcoin on the balance sheet anymore, right? And I think those names are going to certainly start to look more like data center operators. And it's also, I think the management teams are angling for that, right? They have no issue with Bitcoin. They love Bitcoin. It's where they got started and everything. But I do think longer term, they see themselves more as data center companies than kind of specific miners. And some pure play miners will obviously still be out there. There's a couple in the public markets today that are focused on just Bitcoin mining.
And from a financing standpoint, does them getting into HPC kind of change the capital structure of these things at all? Because I know previously when they were mining and expanding, a lot of what they were doing was issuing equity to finance that. Are we going to see more debt come into the mix here?
It's a great question. So the miners, as you guys know, some of them got in trouble with debt back when they were just doing Bitcoin mining. You had to fund every CapEx cycle was fairly intensive. Then they all got rid of debt, and it was focused just on equity issuance. You could get yourself kind of into less trouble. Where it's shifted now is we're back to debt. And I would say HPC is actually way more capital intensive than Bitcoin mining. And Bitcoin mining was already fairly capital intensive. A construction build for an HPC data center is about 20 times the cost of a Bitcoin mining data center. So it's a night and day difference. And you're never going to be able to fund that much equity with it. And also, depending on who you sign your contract with, you can get pretty attractive debt financing rates. So most of them are targeting 70, 80% LTV. So about 80% of the construction build will be financed with debt. So capital structure will change, and then a lot of debt will be layered on, and a lot of it will look like ABS debt. So it'll be secured with the data centers. But yeah, you're going to definitely see a lot of debt layered on. You probably see some equity issuance as well. About 20% of these build costs they do typically put equity into. So at the market offerings or convertible bonds are almost like you can think of them as kind of dilutive effects there. So you probably see more converts as well.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, brought to you by CF Benchmarks, the world's largest crypto index provider. Hey everybody, thanks for joining us for another episode of CFB Talks Digital Assets. I'm Ken Odelega, Head of Content, and as usual, I'm joined by my colleagues, Gabe Selby, who's Head of Research, and Mark Pelichuk, who's our Research Analyst. Thanks for joining us, guys.
Hey, Ken.
Hey, Ken.
And today we have a timely special guest, John Todaro, who's the Managing Director of Crypto High Performance Computing and AI Equity Research at Needham Co. Thanks for joining us, John.
Thanks for having me on, guys.
The reason we have John on is because, as a lot of you know, Needham has exclusively focused on growth companies, and it's, of course, a specialist in crypto and blockchain offerings, with recent deals including that gigantic, a number of gigantic offerings in the market that you might have seen. And one of the most straightforward ways to observe the ongoing integration of digital assets with Wall Street and traditional markets is via the continuing stream of crypto-related corporate actions of all kinds, of which we've seen so many this year. And so we thought really great to have confirmed expert in the room to actually talk about it. So basically, John, there's a number of ways we could start because it's been a really, really busy summer. But let's start this way. Needham has emphasized its focus solely on growth companies and their investors. They want to, your catch line. So involvement in crypto equities for Needham has been a logical progression. 40-year-old, broker-dealer, of course. But most Wall Street firms are still not doing crypto-related deals, believe it or not. So what drove Needham's light bulb moment in your view? Or conversely, put it another way, why, for a lot of Wall Street firms, are they still not getting it?
Yeah.
What would you actually put that down to?
Yeah, of course. So Needham very much does take a look at growth techie companies. That is the focus of Needham. It's been the really kind of how it started in the 1980s. That was where it initially got started. And then also some healthcare companies. So for Needham, it was a natural progression of, hey, this crypto part of the economy almost looks like some aspect of fintech, but it might morph into its own thing. So Needham wanted to be where that was. I think the light bulb moment, and that's when kind of I got hired around, was Coinbase. So you just didn't have many crypto public companies. And then you had Coinbase, and Needham was thinking, hey, what if this becomes kind of a standalone sector? We need someone to cover it and focus on that. So when I joined Needham, I think at that time, and this was around, I think it was 2021, it was we had the first dedicated crypto desk on Wall Street. So my job was to focus just on crypto. I came from the crypto industry. I spent a couple of years at Citi, but my focus was definitely on crypto. So when I joined, and there wasn't a ton of companies to cover at first, it was like, hey, there's Coinbase, and then you can write industry reports, which actually went very well. I think there was a lot of reception from investor community. So institutional investors really wanted to get their head around it. I would say there was a lot of folks who, didn't really participate in the 2017, 2018 cycle. So when 2021 came around, it was, hey, I heard of this before. Let me now dig in a little bit more. Is now a public company. I can invest in Coinbase. So it kind of snowballed from there. The interim period, it was a lot of companies like slowly migrating into crypto. You saw that with Robinhood. You saw that with some of these other public companies. The Bitcoin miners were out there. Fast forward to 24 and mostly 25, you've seen the capital markets open up to crypto in a very big way.
Yeah.
So this year is very different from prior years, where you have a lot of crypto companies going public. You have a lot of existing crypto companies raising additional capital, and you have other companies in fintech moving towards crypto. So I would say, at this point, to be candid, I think every bank is very eagerly looking at crypto. And when we go to market in some of these deals, the competition has certainly stepped up from what you saw a few years ago.
Well, thanks for jumping on the pod, John. For the listeners who aren't aware, be sure to check out Needham and the research that John's and his team are putting out. It's really great stuff. I have it on my list every day whenever it hits the inbox to go through and see what you're saying as far as the coverage on the companies that you're looking at. You kind of touched on this briefly, but maybe give the listeners a little bit of like your crypto specific background. Like what year did you become kind of interested in the space? How did you become interested in space? And I think that will kind of help us kind of bridge this gap of, Wall Street research versus, where we typically sit more on the crypto native side.
Yeah, sure. And that actually reminds me of the disclaimer I need to put out there. Views are my own, not the views of Needham, and none of this is financial advice. In terms of where I got, so I initially got involved in 2013 in crypto. At the time, I was I was an undergrad. My roommate was doing stuff on Silk Road. Not too many guesses. Need to figure out what that was.
You weren't roommates with Sam Bankman-Fried, were you?
No. And so you had to pay in Bitcoin for some of the transactions on there. And so that's when I first heard about it. Kind of around the same time, my brothers were getting involved. They had heard about it from separate channels as well. And so we all kind of bought it around then, 2013. We put a little bit in. I actually had student loan money, and I put a little bit into that, into crypto. The first levered play on crypto.
Nice.
That's perfect.
And so, I think where it just stood out, it was kind of this, like libertarian money. It was just kind of like the initial tagline, it felt like. And then it started to evolve more into a tech landscape that I think made a ton of sense. And so for me, after college, I went to work on Wall Street. I worked at Citigroup, and I traded mortgage bonds. And so I was trading mortgage bonds, and I was like, man, my passion is really more into crypto. So I'd actually send around a crypto newsletter. And everyone who got it, because I would add people at the firm. Why not? And most of them were just like, what is this? Why am I getting this? And, what does this have to do with anything? It eventually became timely because 2017, 2018, crypto went up a ton. So someone on our desk, actually, he went to Kraken. He's like, I just deposited $100,000. I'm just going to buy whatever crypto you tell me to. I forgot which ones I told him to. They probably went down in the 2017, 18 bubble. But that's when it kind of initially got some of the folks at a firm like Citi interested. And so around that time, I didn't want to spend the rest of my days necessarily trading mortgage bonds. And so I left to get more into crypto. And that I eventually went to a startup called TradeBlock, an index product. It's kind of similar to CF benchmarks at the time. And then it got acquired by DC. I was there for about 4.5 years. Got acquired by DCG, Barry Silbert, and then they merged into CoinDesk, which via Bullish just kind of went public. And so then in 2021, Needham came to me, and they very much took the view, which I think was the correct view, of, hey, we want someone from the crypto industry to cover this. We don't want like a fintech or payments analyst to be converted over to cover crypto. And that's what a lot of the other banks did. I think they viewed crypto as kind of just this part of the fintech world. So we're going to have a fintech analyst cover crypto. And I would say today, almost funny enough, it's like fintech's a part of crypto. We've almost come the other way with just stable coins and all the adoption you can do there. So it's definitely a standalone asset class. And if anything, maybe some of these other sectors, which were bigger than it, are now kind of more so latching on to crypto, almost like the AI infrastructure stuff we talked about, than the other way around.
Yeah, no, I mean, I think having the digital asset specific, that crypto native coverage is a huge edge that you guys have. And kind of along those lines, to kind of move us along, what I'd like to get right into is some of the red hot activity we've seen in the equity market this year, especially with, we have companies like Circle raising north of $1 billion, and it traded at one point at a valuation of over 50 billion. We're starting to see some of the financials for companies like Gemini filing to go public. We just had Bullish. So what's your kind of take on the current state of the crypto IPO market? Don't give us anything too specific, but basically I just kind of want your take on the state of the current IPO market. Where are we, and what signs are you looking for, if any, to see when we start to get a little overheated with some of these valuations?
Yeah, and so the IPO market was just closed for so long. So I think for a lot of folks, when you look at it and you see, oh wow, the stock's traded up 2x, 3x, that it screams kind of overheated. But you have to look at it's coming from a very small base. And so I think the bankers, when we're thinking about some of these transactions and how to price them and whatnot, it's a little bit difficult because the market was closed so long that you didn't have a lot of data points about kind of where these things should trade on a valuation basis and kind of what is the market receptive to. And for crypto in particular, it's a fairly new sector. We didn't have a ton of IPO activity in crypto really before. This is kind of the first year you're getting that. So I think from that standpoint, yeah, outside looking in, it can seem like, oh, maybe things are already getting overheated. But that was a market that's just closed for so long. And you're kind of, I think you're probably still fairly early innings of the capital markets activity there. To an extent, it's going to follow crypto cycles, though. Like if crypto is way down, then these companies aren't going to benefit as much, and vice versa. If crypto keeps running and has a phenomenal 2-3 years, I would think capital markets activity keeps going. You also had a lot that was kind of pent up because the prior administration under Biden was just not favorable for crypto companies going public. So you also had a lot that was just kind of pent up that needed to get out, and so it probably moderates it at some point when you kind of had the initial companies kind of front loaded, and then it probably moderates to some extent.
A trend that we're seeing, it looks like, as you mentioned, pent-up demand, specifically for offerings or companies that potentially have been thinking about offering their shares for many years and haven't done so for those very reasons, for those regulatory, regulatory environment that we lived through for a number of years, are now coming to market. Fairly large names that could actually receive similar or in the ballpark valuations as some of the other names that we've seen. Is your sense that investors, seasoned investors, are starting to differentiate, or are we still in a bit of a grab everything that's going because this is a hot market type of scenario? What's your sense of it?
Yeah, so obviously I can't talk on specific valuations and all that. What I would say though is, you have a retail market that certainly has appetite for IPOs and in the first weeks of trading, and you have institutional investors that they're institutional investors a lot of times have a whole team dedicated to just trading initial public offerings and analyzing those, and you just didn't have the market open that much. So those type of folks have been waiting to do stuff, and they have capital to allocate. So yeah, you're seeing a lot of interest on both sides. What I would also say is there's crypto specific interest too, right? I mean, you look at just the way the crypto markets have performed, that it's a real asset class now, right? And it's a real sector, and there's a lot of demand for it. There's institutional funds that have crypto specific teams now that look at maybe not necessarily the tokens. A lot of times it's still in the equities, but their job is to look at crypto equities and to choose to invest in them or not. So you're definitely seeing kind of that dedicated interest. At the same time, like these hedge funds are super smart folks, right? So they are differentiating. It's not necessarily, let me just invest in anything. They are, they have a view on one and maybe a bearish view on the other one. So they are differentiating. I would say in general, though, just with so much pent up demand and just how strong and dominant crypto has been, there's just a fair amount of broad interest in the sector.
I wanted to ask you, I'm kind of more of a macro minded person just because I was a multi-asset investor in my TradFi days. Are you surprised at all, given the ongoing uncertainties that you see in the macro landscape, the fact that the Fed still has their benchmark rate, north, hovering around 4%? Are you surprised at all at the strength of the IPO market this year and these issues that have come to market, and just seeing kind of how I would say these showings, I would say, from these new issues. It's been quite impressive in my opinion, given all the other stuff that's happening over here.
Yeah, but I would say that's even broader than that. Where like, look at where equity markets are, look at where crypto markets are, and even if you make the case that Bitcoin's like a macro uncertainty hedge, like a lot of altcoins aren't. That's kind of more just like a risk on play. So I would say, with interest rates where they are, I think that the thinking would be, hey, it's not like we're in a super dovish environment, but assets are near all-time highs. So I don't necessarily think the IPO market is kind of bucking the trend of uncertainty out there. It seems that a lot of markets are kind of, right?
Yeah.
And so IPO market more so just a reflection of the strength in the equity market, strength in your underlying crypto market, in my view.
Yeah. So it's like you kind of had the window open up because we've seen kind of the equity markets and other risk assets do so well, despite the fact that you've had these ongoing uncertainties.
Yes. And then I would also say, at least with crypto specifically, the regulation change is just night and day, right? So under the prior administration, just a lot of companies couldn't really go public. It would just be a very lengthy process, and it's a lot more favorable now. So you also just saw it's pent up, from that standpoint of just kind of being kind of gate kept, if you will. So it's just opened up significantly more from that standpoint as well.
One thing I would kind of like to get your take on as these companies go public, and mindful you can't talk about any specific issues, but we are seeing the financials of all these businesses start to come out as they file. Is there anything that's surprising you about the crypto specific industry margins or anything on their balance sheet that you think people need to be particularly aware of?
I think, just very high level. There's like some conflating out there. You've seen in retail channels of like conflating volume with like revenue. You definitely don't want to do that. Some of these companies, the way that it looks is you report as the revenue as the volume number. We should look at a net revenue number. I think most folks kind of would get that though and understand that, but I have actually seen it in some media and
Oh wow.
whatnot, and just thought, um, in terms of margin, these crypto companies, it kind of depends on the business, right? All these crypto companies are very different. So the margin profiles will be different, it's different businesses. But like Coinbase, Robinhood, that margin profile looks like an equity brokerage, but maybe even a little bit better, right? So, a lot of these names, it's attractive margins, it's healthy margins. It's not, like there's issues right here and there. So, I think these for the most part these are, standalone businesses, and the sector is just so different too on what the margin profile, like a Bitcoin miner turned HPC provider is going to have a very different margin profile than like a Coinbase.
Yeah.
In our conversation where we were doing the cold open, Johnny said something that was really interesting where we talked about the drivers, of these companies. And when you think about sectors or industries, traditionally we've seen those get bucketed by drivers, right? So they share similar things in common, whether it's, some sort of exposure to, this type of commodity or this type of demographic of customer or consumer. And with digital asset companies that are going public, you have this dichotomy between, let's just say, like a Coinbase, which probably shares a lot more in common with traditional crypto as far as the interest rate and monetary policy impulses in the economy. And then you have the opposite with a stablecoin issuer that tends to benefit, if interest rates rise. So it's like there's a bit of like a diversifying driver within the industry itself. And so I was just thinking, it would be kind of fun, the next time. Well, it's never fun to be in an interest rate hiking cycle. The common grievances of an interest rate hiking cycle is that if you are a banking consumer, you don't get to participate really in higher interest rates in, say, your checking or savings accounts. Usually the banks kind of keep them relatively flat. Well, now with these stablecoin issues coming to market, I suppose that you're going to see rising rate trades surrounding stablecoin issuers in the future because they have that driver of increased margin expansion with the rising Fed funds rate, right?
Yeah, so it's an interesting question, and I do think one, it definitely holds that there's differentiation within crypto that you could almost operate in that cycle with like diversified exposure. What I think actually, funny enough, a lot of these companies would say is they have that naturally embedded in them, that there's some kind of a natural hedge. Like what Coinbase would say is, hey, yeah, our one business benefits from interest rate cuts, and then the other business benefits from interest rate hikes. Where it even gets a little bit more nuanced, though, is there's a thinking that if interest rates do get cut, so that interest income goes down for a stablecoin issuer, at the same time, you could see stablecoin market cap grow, right? Because maybe there's just more crypto activity. So if you do get an interest rate cutting cycle and crypto's just going off, I would expect USDC or just any stablecoin market cap, stablecoin issuance to increase quite a bit. And so, yeah, you're collecting that lower interest on a rate standpoint, but if it's a much bigger pool, then might offset it materially, so might keep you flat. So that's I think the angle too with some of these stablecoin issuers. It's not necessarily, hey, if you're getting a cutting cycle, it's bad for business because it could just grow that supply by so much.
That's a good point.
So the other major crypto-related equity market activity, of course, in recent months and years, has, of course, been the rise of the corporate treasury company that invests in crypto. And of course, among these, MicroStrategy, now called Strategy, is probably the most prominent, right? And it's been the most eye-catching. So, and as we've seen this year, a lot of companies have begun to emulate their strategy on trying to emulate their success. And not just in Bitcoin, also trying to move into Ethereum with companies like Bitmine, SharpLink, and others. So let's talk about that, John, because I think you're going to have a unique perspective on it. I'd like to hear basically your general, color on the market, your general view on the market. Assuming it has substance beyond FOMO, what are the key opportunities that these players are looking at and deciding to go in and exploit? What are the drivers of the newcomers in this space?
Yeah, and I have to be careful. So once again, I won't go talk necessarily specifics, company specifics.
Sure. No problem.
I think there's obviously two sets of corporate treasury management as it relates to crypto holdings. There's companies that have a very robust operating business where they add crypto on the balance sheet for for purposes related to just proper corporate treasury management, concerns with the dollar and all that. That's a smaller amount, right? That's what you kind of saw last cycle. What you're seeing more so now is companies that have a crypto specific team that are adding crypto to the balance sheet as kind of that is almost the operating business in itself is buying crypto assets, whether Bitcoin, Ethereum. I think where some of the success comes from is one, you can start differentiating it too, right? Like you can put together vehicles that are dedicated to specific companies, where it's almost like a regulation arbitrage opportunity, because some countries, maybe a lot of individuals can't invest directly in a certain crypto asset. And so some of these vehicles are almost like regulation arbitrage, but it creates an attractive market for them. Other ones are obviously have a founder led, where it certainly gets a lot of retail interest and retail buyers, where XYZ founder isn't going to sell, he's going to keep being in the market. And then a lot of it, eventually starts trading around kind of like the MNAV for these companies, right? So I think it's something that there was a lot of capital that was kind of pent up to get involved in these markets. And so these treasury vehicles were an easy way to do that. A lot of them have also been through convertible bond issuance, and convertible bonds are kind of like their own market, right? And so investors, look to allocate and need to allocate based on convertible aspects, not necessarily what you're buying with it on the underlying. So just dynamics related to the offering itself, right? You see a fair amount of that from convert buyers. And then also the convertible bond market was also pretty anemic and muted until the crypto issuance too. So you had desks that maybe didn't necessarily have a crypto angle or loved crypto, but a lot of convertible bond issuance was just from crypto companies. So have to take a look if you want to deploy capital into the convertible market. A fair amount is crypto companies. I think it was as high as like 25% or maybe even more of convertible issuance was related to crypto companies.
It's amazing. Yeah. So obviously the key disincentive is, just risk, very broadly speaking. But in your view, because it seems to me to be becoming a space that we're starting to see some incautiousness creeping in. That's you got to interpret it that way for some of these some of these players. You mentioned the sort of like companies for whom it's not their core activity, who may be tempted into the space. And you mentioned in our previous conversation that that's a risk. But what are the key risks for the companies need to be aware of, and maybe as well, are there systemic risks if we see this trend really take off?
Yeah, I would say, if you're a corporate treasury management company, you need to really be cognizant of all the risks and managing it appropriately. I would say most of these crypto companies that are treating crypto additions to the balance sheet as like an operating business, they have smart crypto folks who know the ins and outs of the trading aspects to it, where to source it, how to securely store it. Assuming a big public company knows how to securely store their crypto assets, their Bitcoin, I think that the risk just comes down to understanding potential downside volatility that could come around, right? And we talked about this a little bit before, that for me, having been in 2013, there was always some down market in crypto, and you kind of saw it in 2017, 2018, right, with Tesla, some of these other companies that added Bitcoin to the balance sheet. It was like, oh, when things start to shake, there's a little bit more concern. So I would say, I think corporate treasuries need to understand the potential for downside volatility, how to limit that if they can, and just kind of have a better understanding of that. Because what it also does too is it accelerates volatility too. If these corporate treasuries don't understand that, right? If we have a little bit of a down market and then they all go rush to sell Bitcoin, and maybe they do it poorly, and it causes the market to crash even more. Like, you don't want to just heighten volatility one way or the other. So I do think these corporate treasury companies that aren't treating it like an operating business, as kind of a standalone business, definitely do the work, do the research, hire some crypto folks to kind of do that part of your business for you. And I think that probably pays out a lot more than just kind of going in willy-nilly.
And with these corporate issuers, what we've seen a lot of is we've seen where that multiple of NAV starts getting to like 2-3 times. We'll see them issue equity, and we've seen them use that as a means to buy Bitcoin. But what we have yet to see is that multiple drop below 1 and see if they actually start selling their Bitcoin to buy equity. Now, does that to you seem like there's a risk of a larger unwind if that starts happening? Because it potentially creates the cascade where one company has to do it, and then the price of Bitcoin starts going down, and now all the companies have to do it. Is that possible?
Yeah, I think it very much is. And that's the risk, and that's where you get a little bit more of the risk outside Bitcoin, because Bitcoin is a big, fairly liquid market where you do start getting more of it's just it's a concentrated risk in a smaller asset class or a smaller asset. So from that standpoint, I would say there's a risk in all of them of that, and I think you're going to see bouts of that. I think to think you're not going to see that at some extent is probably a little bit misguided. It's a market like any other. It's not, Bitcoin only goes up, right? Maybe on a long enough time frame it does, because the dollar just goes down. So from that standpoint, it kind of does. But I would say in interim periods, especially as it relates to like a public company, there's going to be difficulties where yeah, there's probably going to be a public company at some point that needs to sell Bitcoin, right? So I do think that has the potential of a cascading effect, and there's steps you can take to mitigate it through derivative markets, and also like a lot of these issuances are far dated too,
Yeah.
2028, 2030. So it kind of staves it off for a bit. And if you're early on it, right, like I would say most folks probably think Bitcoin by 2030 is going to be higher than it is today, and probably right. So, I think from that standpoint that the risk gets a little bit diminished because you just push it out further. But, if you're kind of doing it at the top of the market and or doing terms that aren't as attractive as some of the stuff micro strategy has been able to do, it gets a little bit more difficult.
Yeah. And to me, the selling Bitcoin to buy back shares, it doesn't seem like it's something you would do if the multiple of NAV dipped to maybe 0.8 or 0.9. Because if your assumption is that Bitcoin has a 30% annualized return in the long run, why would I sell it to buy my stock at only a 10% discount? That doesn't make a whole lot of sense. So I think it does need to probably dislocate more than we're thinking right now.
Exactly. And that is very analogous to Bitcoin miners, where even if it's not profitable for them to mine Bitcoin, they're still going to do it, right? Because if you start showing to the market too, hey, it's not profitable, we're pulling hash offline, it's almost a little bit of a cascading effect. And to your standpoint, or to your point, these treasury companies, are very unlikely that they would start selling Bitcoin just that little bit. You'd probably need to hang out there for a while or dip lower. And same thing with Bitcoin mining. Like if you're unprofitable as a miner, for the most part, you're going to probably continue to mine. If it's like that for 6 months, a year, then it does start to make sense where you might just need to cut it and run.
When you're analyzing, say, a digital asset treasury company or one of these crypto treasury companies, I'm not sure if we have an industry standard acronym yet, but we probably need some sort of acronym for these companies. Are there like any red flags, or are there any things that you prefer to see as far as their capital structure, as far as, their order of operations? Should they have an operating, segment outside of just hoarding crypto? Is that appealing, or what are some things that you look for as a research analyst?
Yeah, sure. And practical advice, not financial advice. Um,
Exactly.
so, I mean, look, in operating business, I always like that. If you're generating solid cash flows, that's just gonna, even though we're on a crypto podcast, to an extent, cash is king, or at least cash inflows are king. And so I do like a business if they have an operating, kind of cash flowing business that becomes a treasury, has a treasury angle, which is funny because that's basically a Bitcoin miner. So assuming they sell some Bitcoin and then keep the other part to put on the balance sheet, you kind of do have an operating business that generates real revenue, and, kind of, you can call it cash flows, right? And if they sell the Bitcoin, then you're getting that cash on the balance sheet. And then also you're adding some Bitcoin to the balance sheet. So Bitcoin miners, funny enough, I think kind of fall into that camp, but a lot of times they don't get like the attention as they're a treasury management company. I think they're viewed differently. You think of the treasury management companies as issuing capital to buy Bitcoin, but these guys, it's kind of, they're issuing capital to buy machines, which then acquire Bitcoin. So it's kind of a similar process. So, I do like, I definitely always love an operating business alongside it. In terms of risks, I mean, yeah, you want to make sure, what I think you want to see is differentiation in the strategy. So if everyone's going out and doing the exact same thing, just the valuation multiples can't support all of this, right? Eventually it's just going to get arbitrage with. I mean, everyone's going to go out and launch a company until you just don't get that valuation multiple. So I think the way to sustain a valuation multiple, and for the company to continue to be attractive, is to do something differentiated within that. And so kind of the first phase of the differentiation was, hey, they're doing Bitcoin, I'm going to do it with Ethereum, or I'm going to do it with Solana. I think you're now getting to the point where, okay, different assets have been used. Now what's the next leg of differentiation? And I think that can be good. I think it's just going to push people to get a little bit more creative, hopefully not just taking risks. Like, hopefully it's not creativity just with the risk appetite, but actually some differentiation within that. Like I mentioned about some of the country jurisdictions where you can launch a vehicle in different countries, and all that creates some regulatory arbitrage, which at least is some differentiation out there. So, and I think you'll probably see some of that. A lot of these guys are already working on that, but you'll probably see it to a bigger extent too.
Oh, that's brilliant stuff. Why don't we pivot over to the regulatory side of things? Obviously, we got a stablecoin bill through. I think a lot of us are still looking forward to a more comprehensive bill. So we've got the Clarity Act that's on everybody's docket right now. How do you see that progressing as far as from the research side? Is that a major catalyst, seeing something like that get moved through rather quickly, or if it gets stalled out, does that kind of hinder animal spirits in the sector, do you think?
I think it would hinder to an extent. I think at the same time, with just the regulatory landscape right now, even though you wouldn't have a clear framework of rules, you're still kind of, call it air cover for 3 years, right? So some of these bills, it's more so long term beneficial, where it's going to put the rules of the road for 15 years or so, or beyond, right? But that being said, even if you didn't have it, I think a lot of these crypto companies are in a very kind of attractive regulatory landscape, if you will, for the next several years, regardless of legislation getting done. So I think from that standpoint, my big takeaway when I think of Clarity is it gives crypto companies kind of carte blanche to list a lot of different crypto assets, but they're kind of in a friendly enough regulatory regime that I feel like they more or less have been acting that way to an extent. But this would give them kind of clear rules for a longer term. What funny enough, it probably ultimately does, though, is Clarity would probably invite other traditional incumbents to get in who typically do just have to follow kind of to the T regulation landscape where it's going, right? And so there's probably some traditional companies that are waiting for those type of legislation to get done for them to move in. So funny enough, it probably creates more competition for like the Coinbases of the world. So, kind of the sweet spot for Coinbase in our thinking was just kind of this world where you didn't have maybe clear rules of the road, but you also weren't going to get staking in some of these other products. You didn't get regulators going after it. But at the same time, rising tide probably raises all boats. So even though even if you get that, you probably get more activity in crypto in general. So it's going to be good for Coinbase, even if it does invite more competition.
I think that's fair.
Yeah. And with all this regulatory clarity and the banks getting involved in everything, there's kind of going to be maybe three approaches they'll take. They'll kind of build something, they'll buy something, or they'll, partner with an existing player in the industry. What do you think we're likely to see? Or you think this is going to open up a wave of crypto M&A where we see a bunch of these big banks go out that don't already have a in-house crypto team going out and just buying companies? Or is this more of a partnership with companies like Coinbase or Kraken that could happen?
I think you'll probably see kind of all of the above. Partnerships are very easy for the most part to get done, versus like an M&A deal. It might be a lot more complicated. Crypto companies are also pretty big now. It's not back in the day you could go acquire a Coinbase super easily or acquire a Kraken, right? Like Kraken's still private, but fairly large out there. Coinbase is quite large. Robinhood's pretty big. So you might see, in some cases, merger of equals. But yeah, I think your big banks probably get more involved. So to some extent, it's a little bit of a different business from like the investment banking world that is more institutional focused. Those type of firms like Needham, like a Goldman, Morgan Stanley, they probably more or less just kind of enter into the space. Maybe you make some acqui-hires and build it from there with some of the existing infrastructure and talent you have versus doing a very large, like I don't see Goldman Sachs merging with Coinbase. Like it just doesn't really, I don't think would make sense.
The cultural fit of these two things, like the strat world and these crypto native firms, it's just so different. I can speak as someone who worked in both. So that would make it for a really fun, post-merger environment. I think you could almost make a HBO series based on that. And have some really hotshot director do it. It'd be funny.
Yeah. It's been brilliant, John. You got to come back, talk to us again 6 months time. But, to that point, I'd like to give you the opportunity to just talk about anything that you want to air at all.
Yeah, sure. Well, first off, just thanks for having me, and yeah, happy to come back anytime. One thing we didn't touch on, which is just a big part of what I'm working on too, is just where crypto and AI kind of join together, and not to jam all the buzzwords into to one component there, but you are seeing a lot of overlap, and some of it is a very natural overlap with the Bitcoin miners. They have data center capacity, if you will. AI needs a ton of compute capacity, and we're just in a very power constrained environment in the US. And so these Bitcoin miners are sitting on a lot of that power. And so you are seeing a big merge there. So I think if you're in crypto, you work in crypto, you're interested in crypto, it's going to overlap a lot with AI. And so it's in a way it's a good thing. I think what's made our sector even more exciting, that the names I cover, is you kind of have this AI piece as well. That's always fun to dig into. It's kind of a new sector too. It's at the frontier, just the way crypto is. So it's not. I think it's nice that they're dovetailing. I think they're natural fits too. You think about like kind of agents long term. It's probably going to be they're using stable coins to pay each other and to do different asset transfers and interactions. So I think it's a natural fit. It's something we didn't really get to, but maybe next time we could dig more into that.
Really interesting point. Clearly, most people are aware that miners and AI firms of all kinds, and specifically infrastructure, the guys owning the data centers are, as it were, feeding from the same trough. But no financial advice, but as a potential sort of valuation factor for miners going down the line, that's a thought that a lot of people, I guess, would have overlooked. Perhaps.
Yeah. I think what you're getting at is kind of the valuation premium on AI supporting data centers is significantly higher so better than what Bitcoin miners get. And so, it kind of makes sense that some of these miners are going down that pathway. And it's something that's been very receptive to institutional investors and I think retail investors to some extent as well. So you are seeing a lot of capital flow in. Those guys are doing a lot of issuances, but even outside of primary issuances, those stock prices have performed well. You can see when they sign a lease and get an HPC customer, stock goes up quite a bit. So there is, I think, a fair amount of the capital markets interest in that AI data center component.
We'll dig into that a little bit more when you come back, John.
Thank you.
Thanks, John. That was
Thanks a lot
awesome.
for having me.
Yeah, thank you.
I feel like
Brilliant.
we've gotten this new cohort covered with this podcast as far as going into the weeds of these companies that we typically just don't go this in depth with.
We
these
just
types-
barely
these
started
types of
as well.
industries.
Yeah, there's a lot more to talk about.
Can I ask a funny question? Just if you, because I see what's already on the horizon. I'm looking at these SPACs, start to show up again. If you had to launch a SPAC, what would you launch? As an industry, as someone who's in the industry, covering companies.
This is your personal
This is your
spec,
personal.
John. You don't have
This
to
is not
implicate yourself
financial
at all.
advice. Just give us. I hate to put you on the spot, but if you had to SPAC something, what would you SPAC?
I would love to do something something with agent utilization of crypto. And I know that sounds all buzzwordy and everything, but I think
That's good for SPACs,
into it.
though. That's what you want.
Yeah, that's
I think that is, it's just, I think that's where the puck is going. And you can even with humanoid robotics fits in that too. I think you're just going to see a world where the thing that was kind of exciting about crypto from a tech standpoint was like payment rails, asset transfer rails. And we just didn't really see adoption of that. And I think for the first time, it kind of does actually make sense to tokenize a ton of stuff because it's kind of the native asset transfer between AI and kind of these more internet native software, which is where we're going. And maybe humanoid robots fit into that to an extent as well. So I think that area is just super exciting. And we're finally seeing it where crypto, I think for a while, it felt like, they created this payment rails that we didn't really need. But with internet native applications, that is probably going to become most of our day-to-day. We're going to be interacting with AIs, I think, a lot more. It makes sense that crypto is the native rails to be integrated with them from a payment standpoint, asset transfer standpoint, tokenizing a ton of different parts of that economy. So that's where I think it's exciting, kind of those two dovetailing together.
That was brilliant.
Awesome.
Thank you.
Yeah.
Cool.
Yeah. John, that was brilliant. Well, very well done. Appreciate it.
Perfect. Thank you, gentlemen.
So there you go. That was John Todaro, who is the managing director of crypto, blockchain, AI, high performance computing research at Needham Company. And I'm sure you'll agree that was a lot of interesting information there. I certainly learned a ton of stuff about how to actually view the corporate treasury market, among other things. If you enjoyed the conversation, we now have a ton of episodes on everywhere you get your podcasts. Navigate to cfbenchmarks.com to get all of our other content. And after that, we'll see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.